What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. This is going to be a really cool video that I share with you. I'm actually here in the Dominican Republic at the Life 180 retreat. It has just been awesome experience. We're here for 7 days. I think we're on day 5 right now. We're creating tons and tons of content. It's kind of what we're doing at the moment here. And I wanted to share a really awesome conversation that I had with my good friend, Jeff Kamke from Wealth Energetics. I've had him on the channel multiple times. We always have just really in-depth conversations about, different types of life insurance products, comparing whole life, IUL, term, all that stuff, and really diving deep. And in this video, we just had an awesome conversation about kind of the top misconceptions about life insurance. Like, you guys know by now that I am a big advocate of making informed financial decisions. And the only way you're able to do that is if you have the right information, you have the facts, you have all of your options laid out. Like, how do you know if term life insurance, like buy term and invest the difference, is best for you if you don't even know what the other options are and how they work? And even if you do know those options, there's a lot of misleading, inaccurate information around it as well. So my thing is always to bring you guys content and just education really about how these things work so that you can make the best decision for you. And the conversation that I'm about to share that I had with Jeff is really good for that. We break down a lot of the myths and lies about dividend paying whole life insurance, even term insurance as well, which definitely has its place, but oftentimes people are underinsured. They don't have enough life insurance. They use just the 10 to 12x your income, which, how do you know that's enough for you if you haven't dug deeper into your financial situation to make sure you have the coverage that you need? So we talk a lot about that. So make sure you stick to the end. Some really good stuff here. My only ask, just hit the like button if you find the video helpful. Also, check out all the links in the description. I'm going to have a link out to Jeff's YouTube channel. Highly recommend you check it out. He has some really good content. And then I'm gonna have some additional resources as well if you want to take your infinite banking knowledge to the next level, life insurance, all that stuff. I'm gonna have training on different types of life insurance as well. So make sure you check that out. All right, enjoy the video.
What's up, guys? Jeff Kamke here with Wealth Energetics. I got my buddy Matty Ice here with Millennial Wealth Creator. We're in the studio down here in the Dominican Republic at the Life 180 Mastermind. We are creating more content because Matt and I just can't get enough creating content.
Especially in the studio, man.
Yeah,
we're in the actual Life 180 studio.
Yep.
How could we not?
Exactly. Yep. Hear ya. So we're having a blast down here, learning lots, growing lots, sharing lots, teaching lots, and we just have to continue on with that. So in today's video, we want to talk about some of the top things in the industry of life insurance that we see that are common mistakes, common misperceptions, common errors even. And I think we can even say safely that there's some common misleading things that go on in the industry that are for the benefit of the person teaching or trying to sell and not the best for you, the client. So we're going to jump into some of those things today. And I think I'll just start off with saying that was kind of the basics of it. Is there's a lot of half-truths around whole life insurance and life insurance in general. I mean, I think both sides of any of the sides of the camp, whether it's the term camp, the whole life camp, the infinite banking camp, the IUL camp, we get so hung up on the way we see things. And I think one of the things we've prided ourselves on is giving well-rounded advice, well-rounded pros and cons, when you use certain strategies over other ones, what's going to align with you. And that's something that we want to go into today so that you can understand, the differences in whole life, the differences in term, the differences in IUL, what you need to look out for. And that is probably one of the biggest things that we see is the half-truths that are told in the industry to benefit the company or the person that's selling the product, and they're not giving you the rest of the story, the other half of the truth that might be the downside, that might be the risk, that might be where this doesn't fit for your situation, to be knowledgeable of that. Because even though we love the infinite banking concept and using, maximum funded cash value permanent life insurance with a mutual company, that doesn't fit for everyone. So we want to say, when is that not the right fit for you? So you're an educated consumer to know, hey, I'm in a situation where those rarer ones that maybe IBC isn't the best one. So we want to go into some of those things today of the misconceptions, the things that you need to be an educated consumer with, so that you can make a good decision, not an incision.
Decision.
It's a different
channel.
It's a different. That's our medical channel. For what's going to be best for you to align with your values, your beliefs, your goals, the results you want to have financially, and how an insurance product, even though we're thinking, well, it's an insurance product, how's that having to do with our finances? It's a foundational asset that can make a big difference in all the pieces of your financial life throughout your lifetime. And that's why we love that. And so we're going to get into some of the a misconception. So what would you say, Matt, is one of the top things that you see? It's a big misconception around life insurance.
Well, first I'll start off with I think one of the biggest issues around when someone is purchasing life insurance is a lot of times they're not making an actual informed decision. So here's the thing: is you've got all different kinds of life insurance. One is not necessarily better than another, except IUL. That's another conversation, though. Okay, that doesn't ever really actually make sense. But anyways, talking about like buy term and invest a difference, term life insurance, and then you have dividend paying whole life insurance. Like which one is better? It's not necessarily which one is better from a product standpoint. It's which one is best for you and your goals, your current financial situation. What are you trying to accomplish? And it should not, the decision to get life insurance, regardless of what kind of life insurance it is, should not be taken lightly, because we're talking about, I mean, this is a major financial decision. Even if you're only putting in, $50, 20, 30, $50 a month for like a term policy. I mean, it's still a big decision, because we're talking about financially protecting your loved ones in case you pass away prematurely, right? That decision should not be taken lightly, but we need to look at the bigger picture here and figure out, okay, what exactly are we trying to accomplish with these products? And the only way that we can make an actual informed decision is if we have all the facts, we know what all of our options are. And the problem is, like you mentioned earlier, there's so much misleading information, all these half-truths, and sometimes straight up lies about particularly like dividend paying whole life insurance in order to promote the buy term and invest the difference strategy, which, I'm not a fan of. I'm not a big fan of 401ks and IRAs, but that doesn't mean that those things are not right for the right person. Okay. But what if they're not? Right? What if there is another option? What if there's a much more efficient way to build your wealth? Would you want to know about that? I think most people would, but the problem is there's so much conflicting content around there. Like, how do you actually make a decision? And so it comes down to having the facts, knowing how these things work, what your options are, so you can make the best decision for yourself. It might be buy term and invest the difference. It might be infinite banking with a dividend paying whole life insurance policy. That was the case for me. And I get a little fired up about this, because for me personally, when I started going down the infinite banking rabbit hole, infinite banking made sense for me as an entrepreneur. Doesn't make sense for everybody. I get that. All right. But when I started going down this rabbit hole, like learning the different types of life insurance and how to implement this strategy, I almost purchased an IUL, because that was the majority of the content that came up and the majority of information that came up when I was researching it. And I almost purchased it, and they made it sound so good. They did not tell the other side of the story, all the things that can go wrong with it. So I almost purchased one. Thank God I continued to do my research, because it would have been an absolute disaster for me financially. And I started learning how these things actually work. And when I did, Jeff, it was a no-brainer. It just clicked. As soon as I learned how dividend paying whole life insurance worked, I was like, this is exactly what I was looking for. And it was an easy decision. But I only got to that because I had the right all the information. So that's my biggest pet peeve, like you said, like earlier, the half-truths and the misleading information. It's not that people want to sell IULs, buy term, invest the difference. I don't care about that. Do what's best for you. It's the not telling the whole story and straight up lying about certain things in order to make that sale. That's what I have the biggest problem with.
Yep. So let's get into some of the specifics of the different types of life insurance. And we've got term life insurance. We've got, what we'll call it traditional whole life. That's what most insurance companies would write or agents would write. We've got the infinite banking concept, which is more reserved for like wealthier people, like you said, entrepreneurs, people that are looking to do something more strategic than just covering human life value. You've got IULs, you've got convertible term. So let's start with the term part. What kind of things do we see around term life insurance that are just misconceptions? I think the biggest one is that term life, let's dig into this. Like term life insurance is sold on the benefit of, you have your working years. It's when you're working. You may have your kids growing up. They're going to college. That's like the most important time for, if you had an untimely death, you want to be covered with a policy for maybe 20 years, or let's call it 20 years, probably the general timeline for kids in college. You might go longer than that, but let's just call it 20 years generally. And that's the idea that's covered. Well, that's very singular focused. That's seeing it from just one issue. And there's a second one that people a lot of times use term life insurance for. beyond covering their income, it's burial coverage. Mm-hmm. And they say that, well, term life insurance, you just need those two things covered. So it's the cheapest way to do that. Right. So it's the way to go. And you're missing the other side of the story, because yes, covering your income in an untimely death is massively important. Yes. Obviously, if you're bringing in $100,000 a year and then you suddenly pass away, you need to somehow replace that. And a lot of times, if you're a younger family, you don't have millions of dollars already built up in your retirement accounts or investment accounts to become a quote unquote self-insured, which is another myth that we may get into in this video. I'm not sure where we'll go with it, but that's the concept, that you could do that. And so let's spend as little on this bill, because it's just another annoying bill. Right. It's just term life insurance. It's a bill. So let's keep it as low as possible. Let's do that $29 a month term life insurance coverage, get you covered. And then if you don't die in the income years, then, well, maybe we can get you something for like final expense or something for burial coverage, right? Sure. That's the whole idea, to do that. And obviously, if you passed away in that window, it'd cover your income. And in that time frame, it would also cover your burial coverage. And that's it. It's a very limited view without the other side of the story, and saying, well, maybe that just covering those two things, your income if you passed away, and burial coverage, maybe I would want to do more with life insurance if it was possible. Right. And so many people aren't told the other part of, well, whole life insurance, yes, it's more expensive, but it's going to do so much more for you. It's going to cover you, yes, for your income, but it's going to do more things than just cover your income. It can go with you throughout life. It could serve many functions. Just that, like the cash value portion of it can serve many functions throughout your entire life. Right. And we'll get into maybe some more specifics about that, but it can serve it could be like a 529, replacement or supplement to getting your kids to go to college. But if they don't go to college, they want to be an entrepreneur, they want to do other things, having cash value life insurance can be that, alternative to, not being stuck in like a 401k type of a trap where you can't get the money. You could go do other things with it. Right. You could put them into an apprenticeship. You could do those types of things. So it could serve that function. If you are an entrepreneur, it could serve as working capital for a business. Sure. Or if you wanted to do investing, you could do that. It can serve as a supplement to income streams in retirement, as what we call a volatility buffer, which means if you have money in a traditional like mutual fund or 401k where it's riding the volatility of the market, and you have a year or two where you have negative years, if you are having negative years and you're trying to withdraw out of those accounts during your working or your retirement years, that's a double dip. So if you have $1 million and it goes down 20%, well, you just lost $200,000. And if you're trying to pull out $100,000, because that's what you're expecting to live on in retirement, you just brought it down another 100,000. That's 30%. Yep. In 1 year. Well, what happens if it goes down next year another 10 or 20% and you're trying to withdraw? You've just wiped out over half of your account value. So having cash value life insurance can supplement that. You don't have to withdraw from your qualified money. Yep. You could do a policy loan. You could potentially withdraw the cash value, which we probably recommend the policy loan, so you're not interrupting the compounding. Right. But it can serve that. And so many people are not told that full story. It's only the narrow-minded, keep your bills low, buy term, cover these two little aspects of your income, your burial expense. Beyond that, there's nothing else you need to do, because your investments are going to cover everything else. And investments may not be the most efficient way to go about college savings. It may not be the most efficient way to have business capital. It may not be the most efficient way to avoid taxation in retirement, have that buffer for volatility in the markets, and like you said, compounding the losses when we have a negative phase in the market, a downward spiral where, we're in a correction phase. So those are a few of the things that a lot of people are not given that full, here's all your options, pick which one aligns better for you. Does term make sense for you? And for some people it does. Sure. To make sense for them because of their situation. But we would advocate, if you want term because of that reason, let's maybe tap into some of these other benefits, even if it seems out of reach because of the price point. There's things like convertible term that you can get into, that you can get started. You lock in your insurability, which is very important. I'm sure we'll touch on that as we go along. And that's important. And then you can, later on, you can convert to whole life and get some more of the full benefits of what that can do. And it's not all about price point, because it'd be a higher amount of money you'd have to fund a whole life policy for, but it's going to do so much more for you. And that's just probably the basic thing on term life insurance, that we're not shown the other side, so you can make that full full comparison and full good decision.
All good stuff, man. There's a couple of analogies I'd like to share about. You were talking about buying term because it's cheap. You don't buy whole life insurance because it's expensive. So first off, a decision like this, I mean, actually a lot of decisions shouldn't be made because something is cheap or expensive. That's a relative term. Whether something is cheap or expensive is relative. It's what are you getting for the money? What's the value that you're getting here? Okay, so if I were to tell you that I pay $500 a month for one piece of software in my business and I just stop there, that sound like most people would be like, well, what the heck are you doing? Why are you spending $500 a month on one piece of software? You could probably spend only $50 a month for something similar, right? But then if I told you that $500 for the software allows me to make $20,000 a month in my business, now does it make sense? Well, of course it does, right? And that's the whole story. Okay, so if I just stopped at the $497 a month for one software, that sounds really bad. I might make a different decision over here. But if I know what it's doing for me, the value I'm getting for it, I'll pay that $500 a month all day long to make $20,000 a month, right? And here's the other thing. Again, just it's talking about the giving the whole story. When you're talking about term insurance being cheap, well, that's a relative term. And if you're only talking about the death benefit, then you are correct. Term insurance is always going to be far cheaper, and that we could get down a whole rabbit hole about that, how it's actually not cheaper in the long run, but that might be a different conversation. So it is a lot cheaper than the same amount of death benefit for a whole life insurance policy, without question. But if I were to, this is the analogy I like to give for this, okay? So if I told you that for the same 3-bedroom, 2-bathroom house, 1,500 square feet of living space, and I said people are just like, you should never buy a home, you should always rent the same amount of living space, that would sound ridiculous, right? Because there's a reason that people buy homes. And it's far more expensive. You got to put down a much higher down, or you got to put a really high down payment on a lot of the times. You have property taxes, not to mention the maintenance as well, right? So why would you pay all that extra money for the same amount of living space? It's because there's another side of the story. There's so many benefits to people to buying a house. You have equity, which, hey, guess what you get in a dividend-paying whole life insurance policy? It's called cash value. You have equity that you can borrow against and go build wealth, or maybe it's an emergency fund, something like that, whatever. It appreciates in value. Guess what a dividend-paying whole life insurance policy does? It's guaranteed to grow every single year. Plus, you get dividends as well. So you get uninterrupted tax-free compound growth. That policy is going to continue to grow in value for the rest of your life, okay? And then what's the other thing that you can do with a house? You can pay it off. You can't pay off your rent. Okay? Like if you're renting a house, you can never pay that off. With a home, you can pay that off and never have another mortgage payment again. Guess what you can do with whole life insurance? You can pay that thing off. You could do a 10-year pay. You could pay into a policy for 10 years, 20 years, till 65, whatever makes sense for you. Never make another premium payment ever again. The policy will still continue to grow, and you still get all of the other benefits. You get the living benefits as well. If you get chronic, critical, terminal illness, you get access to a large portion of that death benefit early on. I can't tell you how valuable that is. It's one of the reasons that was really high on my priority list, or the reason I decided to purchase my 2 whole life insurance policies is because I want to prepare for the future. We get old, things happen, we start to break down, and I don't think people really plan for that very well. And wouldn't it be nice to have access to a large portion of that death benefit to get the care that you want, to stay in the facility that you want, or heck, maybe you don't want any of that. Maybe your last 6 months, you want to travel the world. Well, you could do whatever you want with it. And for me, having those options, that control, preparing for those types of scenarios, when you look at you have to weigh the benefits. Like, what are we trying to do? Can this financial product help me solve these problems, help me accomplish these goals? And then you make the decision. So sometimes, like you said, term insurance might make sense right now. I always recommend getting a convertible term policy, like you said, Jeff, because at least then you lock in your insurability. You have the very I like to say cost-effective coverage, not cheap. I don't like the word cheap. And then and then when you're ready to maybe infinite banking is your thing and you want to implement that later, you can do that. If not, you just want to convert it into whole life and always have that coverage, you could do that later. So if you're on a budget right now and maybe you can't afford to put enough into a whole life policy, that is fine. But you can start with term and then convert it later on down the road. So it's just, I think there's a perception problem a lot of the times with these types of life insurance policies. There's not enough real education breaking down all these different types of products so that people can make an informed decision. So like when you lay out all those benefits, do those benefits resonate with you? Okay, great. Let's have that conversation. If not, all right, that's fine. Maybe buy term and invest the differences for you. I don't care. Just figure out what's best for you. That's my thing.
Yeah, totally agree. Yeah, you got to be a well-informed consumer, and you can't make a good informed decision if you don't have all the information.
Right.
Obviously. So I think another thing that I see quite a bit, I know there's a blog post that Dave Ramsey has, and I would agree with him on this, that people don't buy enough death benefits.
Yep.
Another mistake that people make, and I think there's a couple reasons for that. One is a lot of people think, well, I don't even need to buy my own term life insurance or whole life insurance because I have one through work.
Right.
And a lot of times a work policy, I think the ones that I've seen, I don't know if you would agree with this, are about $250,000, about $250,000 worth of coverage. That's about it.
I've
maybe
way less than that.
Maybe, yeah, even less.
So less than that.
That's really, in today's world, we hear $250,000 and that still triggers in our mind like that's a ton of money.
Sure.
But I mean, let's get real. I've seen some stats recently where the amount of money that it takes from living in the 80s, if you made like $60-some thousand in the 80s, you'd need over $200,000 in today's dollars to equal that same standard of living.
Right.
So $250,000 of death benefit, that gets you basically a little over a year of what today's costs are for products and goods and services, cost of living. So it's not enough.
Right.
So one of the things that I've heard Dave Ramsey, and I've done other content on my channel about this, is Dave gives you the metric of you want 10 to 12 times your income in life insurance. And he's talking about obviously in term life insurance only. So let's dig into that. Does that make sense for you? So there's a lot of factors that play into how we would arrive at an appropriate amount of death benefit for someone. And just picking an arbitrary range of 10 to 12 times your income is not going to capture all things to consider here.
Sure.
And you may be a little bit low. You might be a lot low in that number. You might need $5 million of death benefit, but you think, well, I only want to pay $40 a month for term life insurance, so I'll just go with the $200,000.
Right.
Well, unless we really dig in and look at all the pieces, you're going to be underinsured and not providing the benefit that policy is designed for you. So some of those things that we would want to look at are, well, what is your income? Is it going up? Is it staying the same? Some people have a job that their income hasn't really changed a whole lot in their working career. Maybe a percent or two here or there, 50 cents an hour here or there, but generally it's the same. For other people like you and I, our income can spike dramatically over a period of time as we grow ourselves. We learn marketing. So if you're an entrepreneur, you're a business owner, and you're somebody that's a progressive person, you're an expansive person, you're wanting to make changes and upgrade your lifestyle and do things, your income's probably going to go up. Well, 10 to 12 times your income now might look totally different than 5 years from now, what that 10 to 12 times amount might be.
Sure.
So those are things that when we work with somebody, we want to know, what is your financial picture? Where's your trajectory on things? Are you just getting going with the business? And, maybe those first few years are just a struggle getting off the ground, but then you're about ready to break through. Or maybe this was maybe 2023 was the year that you just broke free and you're, maybe you 2x your income or something like that.
Right.
We want to know that so that we can size things appropriately. And obviously your goals come into this because we want to take a look at, ultimately life insurance is planning for the worst possible thing that could happen to you. You pass away and your family's left with what's left.
Right.
You're not there. You don't bring in the income. And I know in my household, I'm the sole breadwinner. So if something happened to me, my family needs to not just be taken care of for a short period of time, a year or something with income. And then my wife has to scramble and figure out what the heck am I going to do to go replace my husband's income and a trajectory of an increase of income, and we, I know for us, we've made decisions based on we're going to be making more money. And as we do make more money, things start to cost a little bit more. Rent a little bit bigger house, you buy a little bit bigger house, you might upgrade vehicles to not be 10 years old, you might go to 5 years old cars. And so that's the natural progression of things. So we want to know a client, what are their goals? What are they wanting to achieve with the death benefit? Are they wanting to just barely make ends meet, and the wife or the husband, whichever one would potentially pass first, the other one's left with bearing the burden of the children and trying to come up with extra income somehow, or working more hours? Like, that could be a terrible thing. So do you want to have enough death benefit in place so that you're more than covered? You've got a ton of time to figure things out. And like for me in my situation, the death benefit that I have on myself, a term policy which was done long before I learned all of this, it was $250,000. And then in my current whole life policy that I'm starting my 7th year, I'll get my statement here in a couple months, but I'm pretty sure I'm close to 700,000 in death benefit from where I started at 400,000,
right,
which is just 10 grand a year of premium going into that,
right.
So it's not that much money going into it, but I know that my family is going to be getting it. If something happened to me down here, I fell off a cliff or something down here and I'm done.
Not hard to do around here either.
Yeah, it's kind of crazy. Yeah, we just had a crazy boat ride earlier.
Yeah, we did.
We joked about needing to pull our life insurance.
Right.
So it can happen when you don't think. And I mean, I had several circumstances in my life where I could have easily been taken out a long time ago. So, but I've got that death benefit that I know my wife would get access to that. She would basically never have to work again, because we know what to do with that money. It's not just we're going to immediately blow it. We know what to do with it, which is a totally different video, totally different discussion. But that's there because we've planned for, we want to make sure that what we want that death benefit to do, it can do at the size that we want to do, so that it can maintain a standard of living. It can continue to expand the remaining family that's left over on their goals and dream and on their path. We want it to still be an expansive thing, not something that it creates more chaos, more stress, more financial burden. That is a big key around sizing death benefit appropriately, so that you're, in the event of this rare thing that can happen, like statistically it's rare, but it does happen all the time to people. So you just never know, that you're in a better position because of it, not in equal from where you're at now, or what we don't want to happen is a worse situation than where you're at now.
Right. And so, a ton. Just real quick though, the peace of mind aspect that you probably have as well, knowing that what you want to happen would happen if something were to happen. That, like, there's just something about that really helps you sleep at night. Just having that taken care of, man. With my policies, it's the same thing. Like, especially knowing too that, I have the living benefits in case something happens to me. I have the, if I get an illness or whatever, unfortunately, if I were to pass away unexpectedly, the people I care about are taken care of, and they have everything that like, there's so much peace of mind around that, man. And I don't think that's part of the conversation a lot of the times. But to get into some specifics about what you said. So first off, about the life insurance at work. All right. So if you have life insurance at work, that is not an excuse to not get more life insurance. First off, you need to know what that is. A lot of people do not know what that is. I've done that. I've worked with clients multiple times where they say, "Yeah, I got life insurance at work." I say, "Okay, great. What kind of policy is it? How much coverage is it?" No idea. So how do you know that would provide enough coverage? Number one. Number two, how do you know you would even get the coverage? Because I've seen coverage where it's just accidental. Right. So you would have to get into an accident in order to get that life insurance. Is that really, like, that's if that's the case or not? So like, you have to know what that is. And like I said earlier, it's often not enough. It's better than nothing. Okay. So even if you are underinsured, yes, it is better than nothing. I will give you that, but that's not an excuse not to get more, not to get a handle on your financial situation when it comes to that. Right. So you really need to know what you have. The other issue that you run into as well with life insurance at work is it's not really yours. In some cases it can be. It depends on the situation, whether you get fired or not, or you leave. Sometimes you do have the option to take that life insurance with you. You can convert it into a different type of policy, but again, you have to know what that is. Sometimes you can't do that, so you don't actually own your policy. So if you leave your job, now all of a sudden you're not insured. What happens if you get sick right before you leave your job and something happens, and now you can't qualify for the amount of death benefit that you would need, right? So these are just things to think about. And when it comes to the amount of death benefit, you were talking earlier about the 10 to 12 times the income. I think that's a very, very basic start, but you need to look at the entire financial picture here. Like, you can't base your decision off that. I would say that's like the bare minimum, but 9 times out of 10, you're going to want a lot more death benefit than that, because it's not just about replacing your income, like so that your family can maintain the same standard of living. Obviously, I think too, it's underplayed, like the grieving process of losing a loved one, what that does to the loved ones, right? So having that cushion for them to grieve in their own way and recover in whatever it is that they need to do to get their life back on track, I think that's massively underplayed in that conversation. And then, I mean, obviously we have to look at debts. What's your mortgage look like? How about your credit card debt? Do you still have student loans that you're paying on? The car loan? How about sending the kids to college, weddings, whatever that looks like, you really have to take all of that into consideration. And just throwing out a number, 10 to 12 times your income, not taking into consideration the actual financial situation here, I think is a bit irresponsible, to be quite frank. And there needs to be a much deeper conversation and a much deeper look into the current financial situation. What do we want to happen if something were to happen with me? What needs to be covered? Then I always go back to this. Then you can make an informed decision, not making a decision off of what some stupid guru told you on the radio. You know who I'm talking about. I mean, right? It's one of our favorite guys. But actually doing your research, taking this seriously. I don't think sometimes people take it seriously enough. And I'm just going to get 10 times my income and then I'm good. And then that ends the conversation. And like you said earlier, it's singular minded, and we need to expand on that, guys. If we're really going to put a solid plan in place for our finances, we want to protect our loved ones. You got to go deeper into this stuff.
Yeah, I'm glad you brought up the debt. I glossed over that, and I like bringing this to light. Like, if you had a $250,000 death benefit and you owe $200,000 on your home, but you're thinking that $250,000 is going to go towards income replacement,
right?
Well, that's fine. But you didn't alleviate a major stressor. Like, would it be better in the case of an untimely death of a spouse to have the mortgage gone? And I mean, in today's world, if you've just recently bought a home in the last few years and it was after the low point of interest rates being at 2 or 3%, I mean, any houses now that I've done calculations on, I mean, you're talking $1,500 a month, like minimum, for a lot of these decent houses for a normal family to live comfortably. I mean, you can find smaller houses for less money, but with interest rates the way they are now, I mean, you're talking some serious monthly cash flow.
It's upwards of like $3,000 a month now.
Yeah,
the average because of the interest rates. Yeah, it's pretty
sure. It's so you got to look at this holistically. Look at all the pieces, like he's saying, because if you get that $250,000 in, like, yeah, okay, you could still keep paying on the house payment, but would it be in a better position if something happened to be able to wipe off the house? You don't have any more debt on the house. It's now a fully paid asset that's going to appreciate over some time. You got the HELOC, which can be sort of a good thing because you can access that, but your credit's got to be there to do it. But that's
and then real quick, just on that, and then the spouse doesn't have to worry about selling the house, or worry about how are we going to stay in the house.
Yeah, very good point.
Right?
Very good point.
That's huge.
Yeah, excellent point. Yeah, so all those things, even around just the house, have to be looked at and taken into consideration. And just that arbitrary 10 to 12 times doesn't look at any of this stuff. You have to look at this so that if it does happen, and this is the whole point of insurance, is planning for the worst, not thinking everything is going to go perfectly.
Correct.
And then you just barely need that term life insurance coverage, and the several thousand you paid over 20 years is no big deal. It's lost. Like, we have to plan, as if this did happen, what do I want this to look like? And it's not pleasant to talk about. No. It's not pleasant to think about, but it's better to actually put in that thinking and planning ahead of time. So if it does happen to you, you have a springboard effect. You can have the weight of, oh, my house is free and clear. I don't have to worry about this. This could be a generational asset now. I could pass this home on to my kids.
Right.
It could go to my grandkids. I could go to a brother or a cousin. You could do whatever you needed to with that house. You don't have to worry about it. Like I say, you don't have to lose it. You don't have to downsize it. You don't have to go into bankruptcy or foreclosure because, oh my gosh, we're in over our heads with this thing now. Like, that's a big thing. So, sizing that appropriately is just so important. So another thing that I was going to bring up is, I've talked to many people where, well, Jeff, I like what you're talking about with the whole life and stuff. And, I can see where a few of these things might come into play, the cash value and some of the strategic ways you're talking about. But, I don't have any kids, so I really don't need a death benefit for anything. It's just kind of a waste. I'd rather put my money into, an index fund or something like that. So I think one of the things that I think you've already touched on was, and let's go into this deeper, is the living benefits that death benefit allows you to do. Yep. And there are some things that this is some stuff that is rarely talked about in the life insurance space, even those that
ever
talk more holistically, and maybe in the IBC world, this is something that just doesn't really get talked about a whole lot.
Right.
And this is, we've had a really good firsthand example, like maybe a secondhand example. Our agency owner, Chris, from Life 180, he's had a situation in his family that he's talked openly about on his channel. So I think he'd be fine sharing it.
I think so.
That his father-in-law, several years ago, I think in 2020, was diagnosed with stage 4 pancreatic cancer. If you know anything about a cancer diagnosis, that's not the one you want.
That's basically a death sentence.
Yep. And long story short, because they were able to access the death benefit early with different riders, that some carriers it comes automatic with the policy, some you have to add it on. You get access with, what is it, chronic, critical, and terminal illness. So if you have a terminal diagnosis like a cancer, we were given 6 months to live, 90 days to
they
live.
gave him 3 months.
Yep, 90. Yep. So they can then take that information to the insurance company. They've got the death benefit there. The insurance company gives them access to, I think, roughly 50%, something like that.
The company's a little different.
Yeah. So, but you're getting a good chunk. So if you have $1 million of death benefit and you get to go access 500,000 of that, what does that look like for you? Because I know a lot of people that I talk to, they don't want to go the drugs and surgery route sometimes, or the chemo and radiation route for surgery. They're more natural minded. They want to know, okay, where else could I go? What else could I do? Could I go to Mexico? Could I go to Germany? Could I deal with a more natural doctor that's going to get to the root cause of it? Maybe a functional doctor, do more extensive lab work that looks at 120 biomarkers instead of 17,
right?
And really get to what is driving the cancer in this situation. So you can afford that care instead of being under the rule of the insurance company on the traditional medical side and say, I'm forced to go drugs and surgery. I'm forced to go chemo and radiation because that's the only option I have.
Right.
And this, with accessing the death benefit early, allows you to have options. It allows you to have control.
What happened with his stepdad?
Yeah, it'd be Hannah's son, or Hannah's dad. Yep. So that's exactly what they did. They went and found alternative care, and he's still alive because they got to the root cause of what's going on. And it may mean that he's never going to be 100% cancer free, but he's just, so that if it was a 90-day diagnosis, he's 12x that diagnosis as far as length of time. And that's probably,
and he's not miserable under radiation, chemo, and all that stuff. He's got good quality of life.
Yep.
I mean, how do you put a price on that?
Yeah, and his, I would assume his core health is probably, his level of vitality is increased.
Yeah. Even
though there's a cancer diagnosis, by doing all those alternative therapies, your level of vitality is going to go up. That's the opposite of what happens with a lot of the traditional therapies. Is that it blasts your immune system. It's designed to keep you this far from death to wipe out the cancer, but not you.
Right.
Whereas the other approach, when you have this option with accessing the death benefit early, to go do what you feel is best for your level of care and your diagnosis. And if you feel like drugs and surgery are it, then by all means, go do it. But you might be able to find a better form of that type of care. You might be able to go to Mayo Clinic instead of your local hospital that might not be as top of line care. That might not be as leading edge. And I've been through the medical system with my dad recently with his passing away. And I've seen it with my wife's dad 4 years ago. And it matters what hospital you go to.
100%.
It matters what level of care you're at. I mean, I know with my dad, I'll share this real quick. The local hospital in my town could not lower his blood pressure on multiple medications, on multiple hospital visits. He'd be in the hospital for 4 days and it was still 180 over 100 on several medications. He goes to the more elite university hospital 45 minutes down the highway, and in 2 days, it's 130 over, 85 or whatever that number was. So it matters. So this death benefit, you don't have kids. You don't have anybody you want to give it to. But it's not just that reason. It's not just a generational aspect. It's a powerful one if it's there. But even if it's not, there's still massive value for you to have a policy and having access to that death benefit to do what you want. In the worst, again, it's the worst case scenario. You get a cancer diagnosis. Let's be real. It's what 1 in 2 or 1 in 3 people are going to get cancer in their lifetime. So let's roll the dice here. Do you want to have an option that might be in alignment with how you want to handle your care? I mean, we talk about values and beliefs for money. Talk about values and beliefs for your healthcare. Do you want to go the traditional route, drugs, chemo, surgery, radiation, or do you want to go find a doctor that you're going to probably increase your chances of longevity and potentially can't use the word CURE on here, but that's the possibility. So that's, I think, one of the things. Anything to add to that discussion?
Oh man, I could add a ton to that. Okay, I'll try and keep it somewhat short, but so let's stick with the so I actually my father's kind of going through this right now. Like the living benefits are massively overlooked in these whole life policies and what they can do. And my father, he's 70 years old. He hasn't actually been diagnosed with like a chronic critical illness or anything like that, but he's definitely, you know, he's struggling. You know, he's fallen a lot more, and you know, he has MS and stuff like that. And you know, even not being able to access the living benefits, he could still take policy loans as well. Like there's options there. But you know, it's been such a light bulb moment, an eye opener for me, like how powerful, like how beneficial a policy would be for him right now if he had set that up however long ago. Because like you said, the hospital that you go to, these facilities that you go to really makes a difference. And you know, he's on Social Security disability and whatnot, and he needed to go to therapy after his last fall. He had he broke his wrist in 3 places. A couple of months before that, he fractured his knee after he had a seizure. So like stuff is going on, and you should have seen the facility he was in. I mean, I got a little nauseous, to be honest. It was not a very good facility. People were nice. That's great. I appreciate that. But I'm not looking for nice really in that kind of environment. I want somebody that's going to take the best possible care of him. And here's the thing. He only had 19 days of rehab available on that. I think it was a Social Security disability, but just it was his insurance. But what if he needed 20 days of rehab? What if he needed 2 months, 3 months? They just kick him out after 19 days. And then he just has to, I mean, you know, we're looking at different options, but imagine if he had access to a policy or something like that where he could get the care that he actually needs. So it's that part of it has been such an eye opener for me. But I want to go back to what you originally said about not having kids and just the power of living benefits. I want to bring that home for myself really quick. So I don't have kids right now. I'm 35 years old. I don't have kids. I have 2 dividend annual life insurance policies, right? For a number of different reasons, but I want to stick with the living benefits because that was high on my priority list when it came to making the decision. That was a very big part of the decision, in addition to the infinite banking concept. But see, for me, being 35, you know, I take pretty good care of myself, whatnot. I don't expect anything to happen, but here's the thing: anything can happen at any time. All right. And there's something about having the living benefits just in case that makes me sleep good at night. And I'm thinking long term as well. I think a lot of the times people are just thinking too short term. I'm gonna solve this problem really quick with the cheapest basic product, whatever. You know, I'm not gonna take it that serious. The problem is that can lead to massive negative consequences later on down the road if you don't plan for these things. And I don't think a lot of people plan for when they're 70, 75, and you know, you start to get sick, your body breaks down a little bit, right? There's long-term care insurance, but how long are you going to be able to afford that? You know, maybe you can, maybe not. I'm not saying not to have long-term care insurance, by the way, but people aren't preparing for one of, if not the biggest expense during those later years, and that's long-term care, medical expenses. So what are you doing to prepare for that right now? And you know, what I was going to say, I got a little sidetracked there, but I'm only 35 years old. I take care of myself. Should I really be worried about what's going to happen to me at 75 and like getting sick and whatnot? You know, I have nothing to worry about. I'm only 35. You know, and I don't have kids. I would argue, yes, I do. The time is now to prepare for that kind of stuff, because the earlier you set these things up, the more benefit you get over the long run. Okay? By the time I'm 75, my 2 policies have had 40 years to compound and grow. Great. Can you imagine what that death benefit's going to be in case something happens to me, and I can do whatever I want with that money? If I want to throw in the towel, like say if I get that 3-month diagnosis and I decide that I just want to throw in the towel, I want to do my bucket list and travel the world, I can do that, right? You can't do that with health insurance or long-term care insurance or whatever. You know, if I want to go to Mayo Clinic instead of the hospital down the street, I can do that if I want to. You know, long-term care facilities. I mean, you're really rolling the dice with insurance on that, and not to mention long-term care. I think it's like $6,000 to $7,000. It might be $8,000 a month on average for a decent long-term care facility. Are you prepared for that? Or if not, what are you doing to prepare for that? And that was a big part of my decision. And here's the thing, to wrap this up, my part of this up really quick, like not having kids is not an excuse. Okay. And I'll tell you this, even though I don't have kids, I might want kids in the future. Having this financial foundation in place, having these things taken care of, like just the death benefit, the living benefits. I mean, that's what we talked about primarily, not to mention all the other benefits that you get, but let's stick with that, right? It makes having kids, the decision to have kids, so much easier, so much more enjoyable as well. So, when you find out you're about to have a child and you already have that financial foundation in place, you're not worried about, how am I going to afford this? What happens if something happens to me? And there's all this financial stress around it. It should be a very exciting, enjoyable process. And not that it wouldn't be if you didn't have that foundation. But what I'm saying is, even if you don't have kids right now, put the foundation in place right now. Maybe use the policy for the infinite banking concept to accelerate the wealth building process. Okay, maybe consider that. But at least get this stuff in place now so you don't have to worry about it later. It makes the decision to build a family and start a family so much easier, later on down the road. So that's my 2 cents.
You saying that makes me think back to the days. I remember the morning we woke up at 5:30 in the morning. I was headed to a B&I that morning, and my wife took the pregnancy test, and I was a dazed man at that point because I would have been 29 years old, and I was not in a good financial position at that point in time. And I did have my $250,000 term life insurance policy, but to pay off the debts that we had from an accident, a year and a half before that, which was my wife and I were in Florida walking, and we got hit by a car on foot. So we had
anything can happen at any time.
Exactly. So we had some debts from just trying to scrape by for a while. So we got the insurance settlement a year later. My wife went to Purdue University, so that's some college debt. It's pretty large. So it's like, okay, if something would have happened to me in that accident in Florida, if something would have happened to me, boom, gone.
Yep.
And what was left wasn't enough. And so, but I think back to when, my son was coming, and I'm glad that there's a 9-month, almost 10-month gestation period. It gives, at least, I can't say for all guys, but I know for me, it gave me a long time to wrap my mind around what was coming and prepare for it.
Good to know.
But at the end of the day, I know when he came, it was like, yeah, we're still not in a great spot. And there is a low grade subconscious, it pops in your mind every once in a while, like, what happens?
Right.
What would happen if something happened to me? What's going to be the status of the family? What's going to be the financial status? And in your heart, you are not fully taking care of your family. And as a guy, that's a big deal.
Oh, 100%.
To know that you're the man of the house, the leader of the house, the protector of the house, and you're not doing a good enough job to take care of that, that hits home deep.
Absolutely.
So I think it's an excellent point that, yes, if you can do that ahead of time, and you go, I can only imagine if I had $1 million worth of death benefit or $500,000 worth of death benefit at the point that we had our son in 2015, and I went into that going, that's at least one major stress off my plate. I mean, there's still plenty more to think about.
Sure.
But it's a significant one that you're not dealing with.
You can deal with them in a lot more, how would you say it? I don't want to say productive, or efficient. You can handle that better without the weight of the stress of not having, your finances in order and having that foundation, right?
Yeah, for sure. So it's just, I think I think what you're saying is accurate, because I think of, a lot of these things, I think of like a clothesline. I can remember back in the day, I was real young, my parents left clotheslines outside to to dry your clothes on. I can remember, you put the heavy blanket or sheet on there, and it really weighs the thing down. And I always wonder, how much more weight could you put on this before it snapped? And I think of that of the stressors like that in life. Okay, yeah, it might not be that heavy of a stress ultimately, but it's still one. And it could be this, like the saying goes, a straw that broke a camel's back.
Sure.
It could be that one stress that gives you a freaking heart attack or a stroke, or just, I mean, it may not even be to that serious level, but let's get real. Stress affects a lot of things that are very minor, but can end up being significant. It can affect our ability to be in touch with our intuition.
Right.
It can affect our creativity. It can affect how good we sleep at night. Yep. And if you don't sleep good for years on end, well, that might have a lowering effect of a lot of areas of your life. Your productivity in your business, and how well you communicate with your spouse, and the attitude that you have when you're at home. And I mean, that's what I talk about so much on this channel, is the holistic nature of all this stuff. We can't just piecemeal it off. It's 10 to 12 times your income, and let's just be done with the discussion. There's so many more intertwined, deep connected things about life and the reality of life and what we go through that these strategies make such a profound difference when you unravel them back, like we're talking about here, and really get into like, oh my gosh, yeah, this scenario was different. If when I had my son, if this was different, like what would that have done? You know, I would have made me more productive in my business that I was just trying to launch at that time.
Yep.
You know, like there's so many things that, I mean, you'll never know, but just knowing that the basics of it, like you'd probably be better. Would it be 1% better? Maybe 5% better. I don't know. It's not going to be like 50% better, but it could be the difference in, you know, being a little bit further ahead. And I've heard the analogy of, you know, if you're 1% better every day, that's 365% in a year. Well, if you're 1% stressed out, that's going to be a negative compounding over time, right? So it's a just so holistic. We can't piecemeal this off. We have to really look at all of it. So
what you're talking about is usually what I refer to as the external rate of return.
There you go.
For a whole life policy, because you know, people get fixated on whole life insurance has a terrible rate of return. That's a whole different conversation, but which is not true. But we fixate on rate of return all the time, like how much, what percentage can I grow my money? We don't think about the external rate of return of something like a custom designed whole life policy can give you, and it's everything you just talked about. Being able to sleep better at night, the peace of mind, not being stressed, and when you don't have that weight on your shoulders anymore, you don't have that mental capacity taken up because of that stress, you are automatically more productive. You have a better attitude with your spouse, like you get along with your spouse better. Maybe it leads to less fighting. You know, it's just all like, how do you put a rate of return on that? I would call that an infinite rate of return for me personally. Right. So like when I go to sleep at night, actually not even just when I go to sleep at night, when I wake up and I'm going throughout my day, because I have that stuff taken care of, Jeff, I instantly noticed a difference in my productivity, my attitude, just not nearly as stressed anymore. Just because knowing I have this foundation in place, I have these certain problems, potential problems, and obviously inevitable problems later on. But you know, because I'm 35, you know, unlikely to happen. But you know, I have these problems already taken care of, and because I don't have that weight on my shoulders, and I don't have that stress taking up that mental capacity, I show up better in my business. I show up better in my relationships. You know, I'm more social, whatever, you know. It's just and that's the external rate of return of even if you don't get a whole life policy. Let's say you do a term and you go outside, you know, you push that ridiculous, you know, 10 to 12 times your income. You actually sit down, put a plan in place, figure out how much you need. You could still get that external rate of return, all that external rate of return of that peace of mind, knowing that you have that in place and those things taken care of.
Yeah, great points. So we talked a little bit about term and a little bit of whole life. Let's get into a topic that I know you're really passionate about, and I'm getting more passionate about the more I talk to you and some others on the team, and that's indexed universal life. So let's talk about a few misconceptions around that. And I think the first one that popped in my mind as I was thinking about this one was a few of the books out there talking about how great indexed universal life is, which let's talk about what that is. It's what's talked about as a whole life policy. It's equivalent to that when it's really built on a term life insurance chassis. Yeah. So that's in some of these books, it's positioned as if it's like on par with whole life insurance, but actually better. Right. It's like whole life 2.0 is the way some of them talk about it. Right. And I think that's one of the biggest misconceptions that I've seen, just as a basic, is the marketing, the positioning of around these indexed universal life policies, that they're what the wealthy use, the wealthy families use this. Yeah. And we know that the wealthy families historically have used whole life insurance. Indexed universal life insurance has been only around since 1999 and really only took off in 2008 or 2009, I think it was. Mm-hmm. So they haven't really been around that long. So there's no wealthy family like the Rockefeller family. There's a great book written by one of our kind of ultimate mentors that hasn't been a direct mentor, but we've read his books and listened to a ton of his content. Garrett Gunderson, I talk about him all the time on this channel. And he wrote a book, What Would the Rockefellers Do? And that book outlines the history of how they've used whole life insurance 6 generations deep to perpetuate and continue wealth. And there was no index universal life 6 generations ago. There wasn't one generation ago, hardly. So we know that they're not using that. And so there's a lot of misrepresentations even in the marketing that make indexed universal life look to be on par, and if not better than whole life insurance. And there's a lot of risks associated with indexed universal life. And I think you're probably more versed on some of that than even I am. So That's probably one of the big things I see about index universal life, where some of the things you get into that fire you up about misconceptions around IUL.
You're going to need to keep me under control.
I know, right?
I could go on for hours talking about index universal life. The first thing I'm going to say is, just like I said before, whether it's term life insurance, whole life insurance, if you want to do IUL, whatever's at the end of the day, it's going to be whatever is best for you. Okay. Yep. As long as you understand how these things work and you feel like that is the best decision for you, who am I to tell you not to do it? Okay. Problem is people don't know how these products work. And that's the most frustrating part. And it leads back to the misrepresentation of the product. That's what I really have a big issue with. And I get really passionate about it because I almost bought one, when I started going down the infinite banking rabbit hole. And then once I found out how it actually worked, I role played in my mind sometimes, like how pissed off I would have been and just how financially devastating that would have been, because I put a decent amount of money into my first policy. And I thank my lucky stars. I found somebody like Chris and heard the other side of the story, because it's often not told how or disclosed and very, very underplayed how risky these types of an IUL actually is. There are so many things that can go wrong with it. And to your point earlier, it's literally the exact opposite of a whole life policy. So if anybody is trying to compare it to a whole life policy, like it can perform better or whatever, run the other direction, because it couldn't be more different. It's built on what's called annual renewable term, which gets more expensive every single year, gets exponentially more expensive every single year. And it could potentially lead to the lapse of the policy. Now there's ways to manage that. But again, now we're getting into something that we have to manage like a hawk. Do we really want to do that? Not me. And the other frustrating part for me with IULs is they show the growth of the policy getting growth in the policy every single year, like a CD product. And they tell people that's going to happen. They show 6.9, I think right now is the average that they show, or like right around 7%, literally every single year. And it's a product based on the stock market performance. It's not invested directly in the stock market, but they buy options. And, it's this really complicated options strategy. And what I ask people is, if you need to be able to answer two things here, or you have no business owning an IUL. Okay. Can you explain to me the difference between cost of insurance and net amount of risk? And do you know how call options work? If you can't answer those two questions, and I could go down a list of other questions that you should be able to answer, but if you can't answer those two basic questions, you really don't have any business owning an IUL. And I don't think people really know what they're buying because the product is so misrepresented. It's touted and marketed as this thing that is going to get you all this upside potential in the market, downside protection, and you're going to get this ridiculous amount of tax-free retirement income. Jeff, I cannot believe some of the illustrations that I have seen that have been sent to me. I remember when I first got my whole life policy and I was talking to an IUL agent. Of course, he said, "Oh, you're leaving so much money on the table. Let me show you an illustration for the IUL, whatnot." He sent me a policy or an illustration showing $212,000 every single year for the rest of my life, starting at 65, as if that like there's no ups and downs in the market, just like nothing. Like he was showing the growth in the policy, like there's no ups and downs in the market, and then $212,000 per year. I think it was like an 8, 10, maybe I've seen 12% distribution numbers on these things. Completely unrealistic, just fantasy land numbers. They look really good on paper, and you take that, and then all of the marketing around it about how amazing it is. Why would you not want to put your money into something like that? 401ks are a scam. Look at this IUL over here, where you can get upside potential, downside protection without all the problems of the 401k. And it's just so misleading. And for me, what like really ends the IUL conversation, in my opinion, is if you are attracted to the concept of upside potential, downside protection in the market, you can get that in a whole life policy. All right. There's not very many that do it. There's 2 companies I know that do that right now, but you can get that with a whole life policy, meaning you don't have all the problems of the IUL. So if that's something you want to do and you don't want to roll the dice with your financial future with an IUL, explore that option. Now, I'm not a fan of involving the stock market in any way in policies like that, but everybody's different. That's an option. But the way that it's represented, man, and the way that's marketed is just egregious. I don't know how some of it is legal. I've seen unbelievable stuff out there, like IUL agents saying you can never lose money. I've literally confirmed this with multiple agents where I'll comment on their videos or their posts or whatnot, and I ask them, so you'll put it in writing that I'll never lose money in this product? Like, yeah, you'll never lose money in this product. Really? I wonder how your compliance department would feel about that. Like, if someone's telling you that you could never lose money in something, run the other direction. Like, the only thing that can really do that is whole life, because it's contractually guaranteed. But you could still lose money with a whole life if you're irresponsible with it. If you over leverage that policy and it blows up, you can absolutely lose money. So I can go on forever. I'm gonna cut it off of that. Go ahead and right. I'd love to hear what you think about all of that so far.
Yeah, I think I'm gonna kind of blend two things. One that's still kind of about whole life, and it's another one, but it fits into the IUL discussion. That life insurance is a investment. It's another misconception, and that's directly into what you're talking about with IULs, because they're promoted as an alternative investment that gives you life insurance benefit, and it's two things that are better together than they are individually. That's the way it's promoted. And because it's attached to option strategies in the market, that there's going to be this major growth opportunity.
Right.
And life insurance inherently by nature is not an investment. There is no risk profile with an investment, or with life insurance. There is with an investment. Right. So you have to look at, okay, if somebody's touting an insurance product as an investment, you need to really do your due diligence on that and say, well, how is a life insurance product being an investment? It might have, the cash value in a strategy that's connected to the market, but that's not the same as saying that, well, whole life is an investment. No, whole life is definitely not. A true whole life policy is not an investment.
Right.
It is a savings alternative. It's a bond alternative. So if you have somebody that's promoting an IUL and saying, well, you're going to get such great growth out of it. Well, there's several questions you need to ask about that, because if it does so well, then does the insurance company itself make a large percentage of its money internally as a whole company through that strategy? And the answer is no. No insurance company has a large allocation of their funds internally in indexed universal life. They don't grow money that way because it's not predictable. Insurance companies are planning 100 years in the future how to have stable, consistent growth.
Right.
And so that's one way. Also, if a company has an indexed universal life product, they probably also have an indexed annuity. Well, those two things are invested in the same sub-accounts of the general fund of the insurance company. So does the annuity perform like the indexed universal life is marketed to? The answer is no, they do not. No. They get significantly lower performance, which if you are looking at a company and they're having an indexed universal life, find out if they have an indexed annuity, and if they do, find out what the performance of that annuity is, and that's probably what your IUL policy would perform at.
Right.
So that's a couple things to consider there. But back to the whole life. If you have a whole life policy and you're somebody saying, well, I've got investments that can outperform that, that's not a very good investment. Well, then right there that they don't understand really what a whole life policy is, how it functions, what its purpose is. It's not meant to compete with an investment.
Right.
It's meant to be a storage place of capital. It's meant to be a savings alternative where it's a great place to put an emergency fund or an opportunity fund. It's a great way if you have a business, like I said, to access capital, to do different things, to invest in businesses. There's a lot of things that you can do from that, but we're not trying to compete inside of a whole life policy with the guaranteed growth with dividends on top of that in a tax-free environment. We're not trying to keep pace with investments. They're two different things. And we're not anti-investments.
Right.
We're just wanting to make sure that whole life gets the correct viewpoints and frameworks and understandings of what it's supposed to do in a financial strategy. Right. Now, do I challenge a lot of the traditional investing methods? Absolutely. We'll probably create more content around that, because there's a lot of things around the traditional investment idea that aren't probably in alignment with your values and beliefs. If you really get into the full mechanics of what is going on with investments and how much are the fees taking away from your earning potential and what you can have in retirement and the overall account growth. There's a lot of things with that probably if you were disclosed again on the full picture, right? We're not just trying to give you well-rounded advice around life insurance. It's all these things have misinformation, have truths around them. And again, this isn't the video to go into all that, but just so you're aware that these things exist. And the buy term and invest the difference. Well, the investment side might not align with you, not just the term side, the investing side might. You might want to invest differently and do it other ways. You might want to do it in real estate. You might want to do these other strategies. So that's probably my biggest thing there that just reflects back to IULs, but it's also just one and in the whole life side as well that, like you said, the one agent said, well, you're leaving money on the table, right? Because you're not getting that growth. Well, I've talked to a couple CPAs that have dealt extensively with infinite banking type policies where it's a cash value life insurance with dividends and a mutual company. And they've looked at, probably hundreds, if not thousands of these over time. And they've said that they regularly see whole life insurance policies designed the way that we would do them outperforming the traditional vehicles. Sure. And this is based on a net result to the client, right? Not numbers on a piece of paper that, well, this one's getting 12% and my whole life's only getting, 3.5, and maybe up to 5 or 5.5 with dividends. And just saying that, well, that's not equal. Well, what is this 5.5 with dividends in my whole life doing compounded uninterrupted over a number of years? Sure. While this one's riding the ups and the downs of the market. Well, this one can pull ahead. So while we're not promoting whole life as an investment, we're promoting it as a savings alternative and a bond alternative and a capital storage place. There's the opportunity where it could, in certain market situations, outperform the traditional vehicles. Sure. And that's okay. It doesn't mean, this kind of cracks me up when I hear this, because so the only thing that can perform better than an investment is another investment. Like, it has to be in an investment category. We can't anything else under the sun perform better. And if it is, then we lose our minds. Well, a whole life policy can do that. It doesn't mean we're guaranteeing that it will, but I think we've been on such a long uptrend in the markets for last, coming up on 13 or 14 years now. I think it's been since 2010 that we've been on the upswing generally. Sure. And, at some point we're going to have a market correction. Well, during that phase of time, and a lot of you and I, we have not lived through a major recession and downward trend in the economy in our lifetime. Yeah. But probably is coming at some point. Well, what's your plan for that? Because putting a ton of money into an IUL, even though you've got upside potential and downside protection, well, that could be a risky scenario with a downward trend in the market, a correction cycle in the market that could last a couple years, right, or more. We don't have any idea. So those are just things that you need to think about and understand the mechanics of what these things are doing, and making sure, again, they're in alignment with what you're wanting to do.
Sure. Yeah, and I'm not, like you said, I'm not opposed to traditional investments and stuff like that. It's funny though, when people say, buy term and invest the difference, don't buy whole life insurance, dump all your money into the market. Well, what I would say is if you're actually that confident in what the stock market's going to do, why not fund the policy first, borrow against it, then invest in the market? Now you're making arbitrage, plus you have the policy, the growth in the policy, but nobody would ever do that because they're actually not that confident in the market because it's so volatile, right? So just something to think about. But getting back to the IUL stuff, just a couple of other things to be aware of. First off, I always recommend reading the book Lapsed by Elon Moaz. I actually did an interview with him on my channel. Really, really smart guy. He talks a lot about that. The book goes into detail about how these things actually operate. Like he went over thousands and thousands of different or universal life and variable universal life. But here's the thing, guys. He did go into IUL also, but it's like you said, a relatively new product. But here's the thing: it's still built on the same broken chassis, annual renewable term, just like universal life, just like variable universal life. And I encourage you guys, first off, read that book first before you make the decision on IUL. You're probably going to run the other direction, just like I did when you do. Okay, when you actually learn how these things work. Elon Musk calls it a completely irrational product, and I absolutely agree with him, because once you understand how it works, no rational person would buy it. Just straight up, okay? But also, I encourage you guys to look at the history of universal life insurance. It's not pretty. And IUL is just the third version of, the second, it's the third one in the line. So you have universal life, variable universal life, and then you have index universal life. That's the next evolution of the product, okay? And when you look back at universal life, So that was, based on like interest rates, kind of like money market rates or whatever. It was a disaster. Okay, because when they started selling them, interest rates were really high, and then they gradually lowered the interest rates over a long period of time, over decades. The policies did not perform anywhere close to what was illustrated, and they completely blew up. I see articles like this all the time, and it breaks my heart. I saw a post on Reddit the other day. This poor lady was asking for help about her universal life policy. The life insurance company sent her a bill for a massive amount of money. They have hardly any cash value in there. They basically have to make a very large payment, a premium payment, in order to keep the policy in force. And I think she was in her late 80s, I think it was. And most of 9 times out of 10, they just let the policy lapse. So what that means is that all the money you put in is gone. All the benefits are gone. The death benefit you thought you were going to pass on to your loved ones, that's gone. The policy just completely blows up in your face. Same thing with variable universal life. And actually, one other article I saw, this lady was 94 years old. She received a letter from the life insurance company saying she owed $24,000 that year. Her cost of insurance was $90,000, but so the cash value in the policy couldn't cover that. She owed $24,000 or her policy would lapse. That's absolutely egregious. And the reason is because it's built on annual renewable term. That cost of insurance goes up every single year exponentially when you get older. And in an IUL, you can manage it with UL, you can manage it a little bit. But even then, you're still really rolling the dice. Oftentimes, you have to lower the death benefit, which, that's a whole other conversation. And so these universal life policies were an absolute disaster. So then they came out with variable universal life. Let's tie it to the stock market. Let's combine life insurance and the stock market performance. Hey, stock market's performing really good right now. Okay, what happens when it doesn't? So variable universal life policies, like when they were illustrated 8, 9, 10%, only did 4, 5, 6%. They completely blow up, lapse, and you lost everything. So now we're going to try it for a third time, really, and now it's better because we're using call options. It's not directly invested in the market. The problem is that with IULs, it's not in really any universal life product. It's not the accumulation phase. It's not the growth phase that's the problem. It's later on, the distribution phase or your retirement age when you get older. Your cost of insurance is skyrocketing. Your policy has not performed as illustrated, which is almost guaranteed to happen because the stock market does not go up every single year like an IUL illustrates. That's not going to happen. And so when you get older, your policy hasn't performed, you start taking policy loans. That's where you really inject risk into the policy. Like if you didn't take policy loans, you'd probably be okay. You'd probably still be disappointed in like compared to the illustration, but you'd probably be all right. But these things are sold as tax-free retirement income vehicles, and they show you that you can take 8, 10, 12% distributions, which is just absolutely nuts. And so that's where the problems start to happen. And so unfortunately, people are going to put money into these things for decades and not find out until it's too late, and they're unable to do anything. And where it's going to be too late to fix that. And realize that I probably shouldn't have done that. And they wouldn't have done it if they had all the information. So it's not the accumulation phase. It's always, it's really the distribution phase. And that's where all the problems come up. And guys, you have to be really, really careful with these products. And I'll tell you, Jeff, there's these other things that these volatility indexes that you'll hear about. We're not going to get into exactly what that is, but it's like these proprietary indexes that they come up with, and instead of selecting the S&P 500 for the options, it's this volatility index. I have literally seen illustrations for these volatility indexes showing 6.9, 7% growth, whatever, and like every single year, which is a problem. And then when you look at the historical performance of the actual volatility index, number one, it was created 3 years ago. That's a problem. But even the ones that were created, maybe 15 years ago or whatnot, they've only done 2, 3, 4%. But they're illustrating at 6, 7%. How is that even legal? And then when I bring this up with IUL agents, the argument is always, oh yeah, but you get a 240% participation rate. Like, and then now we have to describe that. Like, you see these things are so complicated. How on earth can you truly, like, can the average person really like it's going to take the time. Not that they can't understand it. I'm saying, do they want to understand that? Do they have the time to understand that? And it's just absolutely ridiculous. And participation rates can be changed at any time and normally are. How is that going to impact the performance of the policy at that point? So there's so many moving parts, so many things that can be changed, so many things that can go wrong. And I work too hard for my money, and I care too much about my future and the future of the people I care about to roll the dice with something like that. I just can't do it for the potential, which would never happen, but let's say potential extra couple of percentage points in growth than a whole life policy. Like, are we really taking that much more risk with our money to get a couple of extra percentage points in growth when we can use time to, like, a product that has stood the test of time through every recession, depression, financial crisis, both world wars, everywhere, the 2008 financial crisis, the pandemic, it survived everything. These mutually owned life insurance companies paid dividends through all of it. They've never missed a dividend payment, some of them. And you get that 3.5% to 5% tax-free compound growth for the rest of your life. I'd rather do that than maybe get 6 or 7% and really roll the dice. Too many things go wrong, too many things that are not disclosed, guys. And I think it's a pointless product. I think it's a very risky product, very pointless product, because you can get upside potential, downside protection in a whole life product.
Yep, exactly. So and it goes back to the discussion of risk. And like we said, whole life, the whole life and investment, there's a risk profile that there is with investments. It's not with whole life. But when we're talking IUL does the opposite of what insurance is supposed to do, which is whole life. You're taking the risk of you passing and putting on the insurance company. Absolutely. For pennies on the dollar with an index universal life product. You're retaining the risk, because the risk is what happens if any of the levers that they can change, the participation rates, the cap rates, the cost of insurance, any of that stuff, the market not performing, all those levers, you aren't in control of them. So you take the risk of that, right? Because there's no contingency plan there.
Yep.
So you're in a worse position because of that. I know that's what Elon Moaz talked about in your interview, which is a great one. So I'll put the link in here with that at this time in the video, because it's a great interview to understand, some of the differences even beyond what we've described with index universal life and why it may not be in alignment with what you're looking to do. So I think we've covered plenty of the misconceptions. I'm sure there's more that we haven't covered, but I think those are the ones that are probably the most prominent, the most impactful. Sure.
It's just another excuse to make more content.
It is. So we'll do another video, I'm sure, on more that we didn't think about. But thanks for joining me in the studio. I'll put the link to Matt's Millennial Wealth Creation or Wealth Creator website down in the links. Check him out. And it's great. Got a great YouTube channel. Tons of content. You do IBC, the infinite banking concept, but you're getting into more like the hard money lending and some of that kind of stuff as well. You've done heavy equipment investing, so you get into some stuff that I don't actually talk about too much on this channel. So he's a great resource. So check him out. And thanks for joining me. And
thanks for having me, man. It's always an awesome conversation. I always enjoy it.
All right, so guys, if you haven't subscribed to my channel, please do so. Click that button, click the notification bell so you're alerted when we put out new videos just like this with great content on money, all things you need to know to make a difference in your life moving forward so you can hit your goals and dreams and make a bigger impact in the life of yourself, your family, and your sphere of influence. So until next time, guys, have a great day, and we'll talk to you soon.
Take care, guys.